Target shares surging after it beat profit estimates. Meanwhile, TJX is under a bit of pressure as its boosted guidance falls short of what analysts were expecting. Here to help us break this all down and the reaction that we're seeing play out in the stocks today, we want to bring in David Wagner, Aptus Capital Equity Analyst and Portfolio Manager. David, it's good to see you. Let's start there with Target. What's your takeaway from the quarter? Because yes, the results were better than what the street was looking for, but when you dig down into this report, still clear pressure on the consumer, which obviously is a concern here for Target.
Yeah, well, first of all, I want Brad to send me his cliff notes on all the beauty stuff he finds out.
Got you covered, Dave.
I need all the help in the world being a Cincinnati guy. But when it comes to Target, I'm probably going to take the other side of this trade relative to how the stock market is allowing it to perform this morning. It's up like 14%. But, I think if you actually look down into this report, I think it could actually create another overhang on the stock through the increased volatility surrounding margins. But heading into this report, I was really focusing on three different things. The first one was actually going to be, I wanted to see balanced top line growth. But as we saw with comps right now, that would suggest, and to your point, Shauna, that sales, they're going to continue to decline. So that's strike one for me. Secondly, if you look at, I wanted to see some type of stabilization in shrink. That also has continued to not happen. So that's strike two in my mind. The last thing that I was focusing on here was, can the company manage their operating expenses? But if you look at the report, they got some benefits through some exogenous forces in my mind, like lower freight costs. So I guess they were able to do that just with some cost savings and some better favorable mix benefiting margins. So it's not a complete strikeout for the company. But if you do focus on the third aspect there I'm talking about, and that's the margin profile, it seemed like it was pretty much a low quality beat there off of lowered expectations because the margin was really driven just by merchandise getting a benefit of 3% year over year better margin expectations. But they benefited from lower freight costs, better digital fulfillment costs, and favorable category mix. So that was, offset by shrink. So it wasn't a great beat there. I do understand, that valuation is very palatable in this name right now, trading at, say, 12.5 times forward earnings, and that expectations for the name were, well, they're set really low heading into this report. So I'm not really surprised that we're gaining a quick exuberance in the stock price of 14%, because as their previous earnings reports have shown, this stock right now is being led by short-term holders in the name, and they're the ones moving the stock right now. The long onlys are not playing right now. So I think that if you're a short-term investor, you saw some benefit from margins, so I'm not too surprised by the move in the stock.
David, how is Target positioned going into what is going to be a highly promotional and what is actually based on some of the deals that they've already put out there and many of the other retailers too? How are they positioned in the midst of a highly promotional season that's going to impact margins?
Well, I think that's actually one of the bigger drivers of what my merchandise gross margin increased from like 24.7% this quarter last year to 27.4% this year. So it came off much better than expected. But, I'm not solely focusing on that part because, inventory has been a problem for them for quite some time. It's actually what I'm focusing on, Brad, is what you brought up before. It's the grocery side of the mix. I love comparing Target to Walmart. Yeah, Target's a big player in the grocery side of the business. They get about 30% of their revenue from that aspect. But if you look at Walmart, they generate about closer to 60%. And we know that people aren't spending any type of money on any type of big ticket or any type of home improvement right now. They're spending a lot of their time on buying staples, buying that beauty you were alluding to before. And that's more of my focus there than some of the benefits from the problems of last year's inventory.
David, how are you looking at the threat of theft and what we've seen play out within so many of these retailers? Obviously, it's a problem across the industry, but in Target's earnings, it still shows that theft, they're still struggling with exactly the challenges and the impact that they're seeing from it.
I just don't know how this stops. It's pretty binary to me or not. Is shrink continue to happen or it's not continuing to happen? It's been, 4 quarters in a row, the company's blaming their margins on increased shrink. And as I told you before, that was the second largest aspect I was really focusing on this earnings report is, what is the commentary around shrink? Has it plateaued? We know they closed 9 stores over the last quarter, but, from the commentary from Brian Cornell on the earnings call here, it just doesn't seem like it's slowing down right now for them.
And so when we think about ultimately going forward from this point in the retail environment, what do you need to hear from Target on this earnings call that would signal to them, or to signal to investors, even though we're seeing shares sent higher by about 14% here pre-market, that would signal to investors that this is a company that not only has a handle on shrink, a handle on the grocery aisle, but also a handle on when they could start to repurchase shares too, because that was something in the quarter that came out as well. They didn't repurchase any stock, even though they have plenty of kind of fuel in, or at least what they've communicated to the street, they're willing to and anticipating to purchase.
Well, if they, I think that should be pretty normal blocking and tackling if they should be buying back their shares at 12.5 times earnings. I mean, that's like 2 standard deviations below their historical average, even if you take out the 2014 spike and the COVID spike right there. I think Brad, it comes all down to balanced top line growth. That's what the street needs to see for the long onlys to get really back into this name. I mean, one of the biggest problems that they've had is they've kind of lost their brand recognition as the go-to retailer. And if they can't get that back, well, one, they're not going to get their historical valuation that they've gotten, which is closer to 16 times. They could remain around that 13 to 14.5 times that they're trading right now. But if they don't get that brand recognition back, I think that the market's going to have to see some type of signal from the board that Brian Cornell, well, he's probably got to go.
He's got to go?
Yeah. Get him out of here.
So right now, I guess, so that's a lot to unpack. I wanted to bring up TJX. So let's stick with what you just said about Brian there. If we do, in fact, do you think that that's something that's going to, I guess, gain momentum here if we don't see that turnaround? And I guess if you're already saying now he needs to go, is there someone within Target, or who do you think should then potentially replace him?
I don't think it's something that should happen this quarter. I mean, obviously blocking and tackling, on the board regarding buyback should happen. But, what is the name recognition here in the retailer space on the brand side? For the longest decade, it's been Target. I mean, that's why they got such a valuation re-rating, at the earlier part of the 2010 decade. Like, everywhere you read on any type of meme, going to Target, trying to spend $20, you come out spending basically $2,000. But that really just hasn't been the case. They've lost some of their clientele. They've made some wrong steps from the vision of their marketing side. And if they can't get that top line growth back and make sure that, consumers understand that they are the brand retailer that they were 10 years ago, I think that Brian Cornell, he should be on the hot seat.
All right, David, quickly, let's get to TJX here because we're seeing some movement on the heels of these results. When you take a look at the comp sales that the company did report here, showing that home goods comp sales, they were up 9% compared to a drop of 16% just about a year ago. Taking a look at TJ Maxx, their comp sales also coming in better than expected. What does that tell us just about how some of these discount retailers are positioned at this point in the economic cycle?
You're exactly right. This is becoming a trade down story. That's why you have TJ Maxx valuation of 23.5 times earnings, and you got more of a Target, which obviously has more exposure to big ticket items, at trading at 12.5 times forward earnings right now. I mean, I really legitimately look back at this earnings report. On its first glance, it was an awesome report. They beat on sales, they beat on earnings, they raised guidance on stronger comps driven by, increased traffic. And then, they're also increasing their market share. Then I looked at, the report again, and it was actually even better than what I saw really at first glance right now. So this was kind of an awesome report. And it almost seems like it's the market's taking a playbook out of Seinfeld's George Costanza and doing the exact opposite of what they probably should be doing. Because I thought Target's report wasn't great. The stock's up 14%. I thought TJ Maxx report was absolutely awesome, and it's down 2 or 3% right now. So I guess it paid to do the opposite here.
All right, David, we got to leave the conversation there. We appreciate you jumping on with us this morning to break down some of these retail earnings reports. And no doubt next time I'm in Ohio, I'll hit you with my my skin routines that I have for the weekends usually here. David Wagner, who is the Aptus Capital Equity Analyst Portfolio Manager. Yep. David, appreciate the time.